Welcome to mutual fund chapter again. Next paragraph is cost incurred by mutual fund. Mutual fund incur certain cost. It is also an organization. They also incur some administrative cost. If mutual fund incur more cost, is it a good news or a bad news for the investor? Bad news. Because more cost they incur, less will be the return of the investor. So inverse relationship. High cost are the cause of below par performance of some mutual funds. So some mutual funds have performed below their peer groups, below benchmark because of the high cost. So what are the two types of cost they incur? One is called initial expense. Then your question is, what is initial expense? This is the expenditure they incur when they launch a scheme for the first time. So attributable to establishing a scheme under a fund. So it is a new scheme expenditure. And that time they have to do aggressive marketing. It's like as good as marketing of Pepsi or Coca-Cola. Marketing of Vodafone and Idea sales, mobile service. Okay, as aggressive as this. So they will contact all their agents and they will tell them that you have a target, you bring the clients and will give you so much commission. So advertisement, client commission, everything. And then of course regular running expense that will call recurring expense. Because every year you have to pay the fund manager their fees, AMC fees, management expense. So this in this chapter we will call management expense ratio or just expense ratio. Two terms have the same formula, management expense ratio, in short MER or expense ratio, which is made up of. Now what is expense ratio equal to? This will come in one more paragraph, so that time we will not discuss. Okay, we'll save time there. So management expense will comprise of cost of employing technically sound investment analyst. So it's basically the salary that you pay to the people who manage that scheme. Then administration cost, advertisement cost, including promotion and maintenance of the scheme funds. Mutual fund also involves lot of advertisement in newspaper, radio, TV, behind auto, bus. Okay. Management expense ratio is measured as a percentage of the average value of asset during the relevant period. Now SEBI has said that you have to disclose your management expense ratio also to your investor periodically. How much you are incurring, so that they will take a more informed decision. How do you calculate this management expense ratio? Expense divided by average value of portfolio. Expense divided by average value. Or in case if you are given expense in per unit term, if expense is given in per unit term, then expense ratio will be expense incurred per unit upon average NAV. Okay. Expense per unit, write the underline the formula, highlight the formula. Expense per unit upon average NAV. We'll take one example on that, so I'm not writing now. Expense ratio relates to the extent of asset used to run the mutual fund. But this ratio should not be very high. If it is high, it will reduce the return of the investor because it will be borne by the investor. Now what will be included in expense ratio we have discussed? It will include, earlier we have mentioned, cost of employing technically sound investment analysts, in administration cost, advertisement cost. More specifically, it will include the travel cost, management consultancy and advisory fees. What it will not include, it excludes brokerage. That means the brokerage paid for buying and selling security is not included, because that is related to purchase and sale activity. Purchase is recorded with brokerage while sales are recorded while without brokerage. Okay. So since brokerage is necessary for buying and selling the stock, brokerage paid during the year will not form part of expense ratio. Now dear student, solve illustration number 4. A mutual fund opening NAV is 20, closing NAV is 24, expense per unit is 0.50. What is the expense ratio? NG 2.27. How did you get it? So first I will write average NAV. How much is average NAV? Opening NAV plus closing NAV upon 2. How much is opening NAV? 20. Closing NAV divided by 2. So 22. And then expense ratio. Expense per unit upon average NAV. Expense per unit is how much? 0.50. Average NAV multiply by 100. 2.27. This way you have to present the answer. Any query? No query. Why? Seems you have understood. So that was about expense ratio. Okay. Now one more interesting part in this chapter is calculation of return. Calculation of return earned by the investor. In your notes, paragraph 4, it says computation of return. Have you finished writing? Investor derive 3 types of income from owning a mutual fund units. Which are the 3 income? Cash dividend, capital gain disbursement. What is capital gain disbursement? At the time of sale, suppose mutual fund makes some capital gain, that also they distribute to the investor. Suppose mutual fund have sold investment of 100 crore at 200 crore rupees. So how much they earned? 100 crore rupees. So that 100 crore rupees profit that they made by selling that investment is distributed to the investor. So that we will call capital gain disbursement. But for the investor actually it does not matter. Both amount he receives in his bank account. So he is really not interested what you call it, because both are realized income. Here the amount actually comes to his bank account. Okay, many investor may not even bother to know what is capital gain disbursement or what is cash dividend. As far as money comes in my bank account, I am happy. Is it right? And then the third one is called changes in the fund's NAV per unit. That is the difference between closing and opening NAV. This is an unrealized capital gain unless you sell that unit. So my total return will comprise of realized gain plus unrealized gain. Realized gain will be dividend and capital gain disbursement. And what is the formula for calculating the rate of return? The formula is dividend you will take plus realized capital gain plus unrealized capital gain and divide by base net asset value. Or formula wise, what you will do, first in the numerator you will write D1 dividend received plus CG1 capital gain disbursement plus closing NAV minus opening NAV, NAV1 minus NAV0, closing minus opening NAV, divide by opening NAV. This is the amount from where you started, and this is the amount that you earned. These two are realized gain, this difference is unrealized gain. So this is my income in the numerator and investment in the denominator. The difference between NAV minus NAV0 is your unrealized gain, plus D1 plus CG1 is your realized gain. So income divided by investment will give me return for that period. While solving the question, whatever is not given, put 0 value. In some question, capital gain disbursement will not be given, 0. Dividend is not given, 0. Now we'll solve one easy question first. Okay. A mutual fund that has a net asset value of rupees 10 at the beginning of the month made income and capital gain distribution of rupees 0.05, such a poor mutual fund, and 0.04 per unit respectively during the month, and ended the month with a net asset value of 10.03. Dear student, compute the monthly return. So compute the monthly return. So what you should do in the exam, first you should write down return percentage equal to dividend plus capital gain disbursement plus NAV1 minus NAV0 upon NAV0. Write down dividend is how much? 0.05. Then capital gain disbursement 0.04. NAV1 10.03. NAV at the beginning 10 divided by 10 into 100. Final answer 1.2% per month. They've asked monthly return. If they ask you find out the equivalent annual return, multiply by 12. So 14 point something. Okay, now one more question for you this time. A mutual fund raised, mark important, from your ICI study material. Source of this question, ICI Financial Services and Capital Market Study Material. A mutual fund raised rupees 150 lakh on 1st April by issue of 15 lakh unit at rupees 10 per unit. Okay, so that is 150, 15 into 10. The funds invested in several capital market instruments to build a portfolio of rupees 140 lakh. To build a portfolio of rupees 140 lakh means at the beginning they started with 150, but they have invested 140 lakh in investment. So what is your cash balance at the beginning? 10. Then out of 10, initial expenses amounted to rupees 8 lakh. So you will reduce that 8 also. So now you have 2. So one working note, like in one earlier question, cash balance you have to find. During the month of April, the fund sold certain investment costing rupees 44.75 lakh for rupees 47 lakh. So add 47 in your cash balance and purchase another security for 41.6 lakh minus 41.6. The fund management expenses for the month amounted to rupees 6 lakh, of which 50,000 was in arrear. So for cash balance calculation, you deduct 5.5 lakh. But for NAV calculation, this expense accrued will appear in the liabilities. Okay, 50,000. 50,000 will come under liabilities. The dividend earned was 1.5 lakh. Add in cash balance. 80% of the realized earning was distributed. There will be two distribution. On one hand, you have one capital gain also on the screen. Investment of 44.75 lakh was sold for 47 lakh. So you have a capital gain realization here. 80% of that amount you will distribute as capital gain disbursement. Deduct from cash. 80% of the dividend that you have received will also be distributed to the investor. So that will also reduce your cash balance. Then the market value of the portfolio at the end was 147.85 lakh. So this you will add in the assets. An investor subscribed to 1 unit on 1st April. So if he subscribed to 1 unit, it means he paid 10 rupees at the beginning. Okay. And disposed it off on the closing NAV. Now this closing NAV will get from the first answer. The closing NAV will get from the first answer. Do you understand? That is why this is a mixture of two types of problem. First you have to find closing NAV. That will be used to find out the rate of return of investor, which we learned just now. Investor will earn three types of return. dividend, capital gain disbursement, and the difference between closing NAV and opening NAV. Determine his annual rate of earning. So first you will try, or should I try? You will try. Try. I have almost drawn the format for you so that the student can write fast. My question number 1 is, what is closing NAV per unit? My question number 2 is, how much rate of return the investor has earned? Anybody got the NAV per unit? 9.85. Oh, because of the answer printed. Yes, that was a help that you got. Otherwise, on your own, it was difficult. Yes or no? Say no. We are capable. Okay, now check the answer. I will solve. First is your amount in the beginning. Opening bank balance 2 lakh. 150 minus 140 investment minus 8 initial expense. Proceed from the sale of security 47. Dividend received 1.5. Cost of security purchased 41.60. Okay. Then fund management expenses paid in cash 5.5. Capital gain distributed 80% of the capital gain, which is 47 minus 44.75. How much they have distributed? 1 point? Just check it. 1.80? 1.8. And then dividend distributed is 80% of the dividend which mutual fund have earned. 1.20. So therefore closing bank balance, all pluses and minuses put together, how much? Closing bank balance 0.40. Is it 0.40? Say yes or no. You have not written, but you should write properly, no? 0.40. Institute has written. I want you to check. Then closing market value of the investment portfolio 1. So my total asset in the outer column 148.25 less arrear of expenses is how much? 0.50. Closing net asset 147.50. Who said that? You are misguiding the whole country. Number of units 15. So closing NAV 9.85. So what is the rate of return the investor has earned? So for that you understand this answer. I think the answer is printed. Understanding is enough. First of all, what is the income received from the mutual fund? In your previous answer, you will notice capital gain distribution was 1.8 lakh and dividend distribution was 1.2 lakh. This is what the mutual fund has distributed to over 15 lakh units. Per unit amount received, just check on your calculator. 1.8 plus 1.2, 3 divided by 15. Is it 0.2? 3 divided by 15 is 0.2. So that is your dividend plus capital gain distribution. Then there is a difference between closing NAV and opening NAV. This fellow started the year with 10 rupees investment and end of the year it is 9.85. This 9.85 is your step 1. So therefore there is a loss or gain? Loss of 15 paise per unit. And therefore net earning is 20 paise gain, 15 paise loss, 0.05 net earning. And initial investment is 10. So rate of return monthly. Why monthly? 1st April and 30th April. 2 dates are given. So per month he has earned 0.5%. So rate of return annual will be 0.5 into 12, 6%. Write 0.5 into 12. So this was the question. Determine his annual rate of earning. What you have calculated 0.5% is your monthly, multiply by 12. Okay, done. What is the expense ratio? So what is your expense here? Expense is that 6 lakh rupees, na? So initial expense is not counted. For expense ratio, your recurring expenses are counted. 6 lakh. And your average NAV will be, opening started with 10 and closing is 9.85. So 10 plus 9.85 divided by 2. Yes. 9.925. And your expense per unit will be 6 lakh divided by 15 lakh. 6 lakh divided by 15 lakh units are there. No? The expense per unit is 6 by 15. How much is that? Point. One student is asking and he is only not replying. What is your expense per unit? 6 lakh rupees divided by 15 lakh is how much? 0.4. Average NAV 10 plus 9.85 by 2, 9.925. So therefore expense ratio will be 0.4 divided by 9.925. Huh? Okay, roughly 4.03%. Whatever, but because of the data, this is what you will first write, and then you can write a note. As a student, this is what you have to stop at. Okay. There may be so many regulations, but when they ask a numerical question, normally we just restrict ourselves up to the data given. Because initial expenses is just one time event. If suppose next year I have to compare with previous year, then it is difficult to compare. If I compare with existing scheme, but then it is also written expense will cover what? Second item will cover what you read, no? See, initial expense is not covered in this ratio. That is only one time expense. See, point number 2 is written ongoing recurring expense, which is made up of cost of employed technically sound analyst, admin cost, advertisement cost. Management expense ratio is measured as a percentage of average value of the asset during the relevant period. So average expense will be for the period. Initial expense we don't consider here. Suppose next year I have to compare with my previous year, I will not be able to compare. If I have to compare with existing scheme of another company, similar scheme, banking fund of Reliance and HDFC banking fund. Existing Reliance banking fund and HDFC new banking fund launched in this year, we cannot compare. Now my question is holding period return. This we have discussed or pending? Pending. Holding period return is also same. But like the previous problem, whatever you have earned in that period you first calculate. If they want you to annualize it, then you have to annualize it. For example, if you are holding it for 1 month, then into 12. If you are holding it for a quarter, 4 times, multiply. If you are holding it for 6 months, 2 into 2. If you are holding it for 4 months, into 3. If you are holding it for 2.5 months, multiply by 12 divided by 2.5. Like this. So simply, if you are holding it for any other period, you calculate the return as we have calculated. HP return, calculate and multiply by 12 by N to get the annual return. If you are given in days, for example, then you can take 365 by n. Okay. Holding period return formula is what we learned just now in the last problem. And if they ask you annual, depending upon what is your n, if it is given in months, 12 by n, if it is given in days, 365 by n, so that will give you your annual return. Now again they have repeated the same formula for holding period return. Difference between closing and opening NAV plus capital gain distribution earned plus dividend or regular income received. Dividend plus capital gain disbursement plus closing and opening NAV difference divided by opening NAV. Solve one small question which was asked in the exam for 4 marks in SFM, and now the institute has given in this new material also. Okay. A mutual fund that has a net asset value of 20 at the beginning of a month made income and capital gain distribution of 0.0375, 0.03 per share respectively during the month, and then ended the month with an NAV of 20.06. Calculate monthly return. Add one more question. Kindly calculate annual return also. Kindly calculate annual return also. Okay. Question from SFM exam and current module of the institute. So the answer is, first I will calculate monthly return. Write the formula. Dividend. In the exam, write properly. If you are writing short form, explain short form below. Plus capital gain disbursement plus closing NAV minus opening NAV upon opening NAV. Dividend is how much? 0.0375. Capital gain disbursement is 0.03. Closing NAV 20 point. Opening NAV divide by 20 into 100. Final answer 63. This is monthly. Therefore, annual return will be 0.6375 into 12. How much? 7.65% per annum. This way you will solve the problem where dividend or capital gain disbursement is received in cash. But there is another scheme sometimes they offer. They say you don't receive this dividend and capital gain. You reinvest it in the units of the same mutual fund. So in that case my calculation would change. But before that I am going to solve one more problem. This is again asked in SFM exam, but not from this module of institute. Extra question. A has invested in 3 mutual fund schemes. Is it there in your notes? ABC. Date of investment, amount of investment, NAV at entry date, dividend received up to 31st March 14 and NAV on 31st March 14. Required, what is the effective yield on per annum basis? Effective yield on per annum basis in respect of each of the 3 schemes of Mr. A up to 31st March 14. So now what you do, dear student, you want to solve in the form of a table or separately for each of them? Table. Draw the table. Write down the heading. Calculation of effective yield on per annum basis. Calculation of effective yield on per annum basis. Right hand side 3 columns. Write properly, you will get full marks. Right hand side, mutual fund A, mutual fund B, and mutual fund C. So first point A, write down, draw a table till the end of that box. Date of investment. Date of investment is 1/12/13, 1/1/14, 1/3/14. Amount of investment 50,000, 1 lakh and 50,000. NAV at entry date 10.50, 10.10. Wait, we're not copying the question. Something we also have to do. After copying the first three lines, the next task is how many units will be acquired by the investor. Up to 4 digits you have to write, 4 decimal places. So tell me, 50,000 divided by 10.40 is how much? 4761.9048. This I will tell you 10,000. This I will tell you 5,000. Now write dividend received up to 31st March 14, 950, 1500, nil. Dividend per unit. Dividend per unit. Now dividend per unit will be, you have received 950 and number of units. So write F divided by, E divided by D. E upon D. Up to 4 digits, no problem. 0.19. No, I have a doubt. Is it right? Okay. 1500 divided by 10,000. 0.15. Last one I will tell you. 0. NAV on 31st March 14. 10.40, 10, 9.80. So this is the basic calculation. Now holding period return percentage. Which numbers we will add? Dividend. Where is dividend? F. Plus difference between closing and opening NAV. What is closing NAV? Point number G. Minus C upon C, and you will multiply by 100. So very simple. Take your number 1.1995 plus 10.40 minus 10.50. No, closing is 10.40, opening is 10.50. You don't have to minus the smaller number and from the bigger number. Closing has to be deducted from opening. So how much is the answer? Into 100. 0.9476. Is it 0.947? Okay, second one try. 0.15 plus 10.10 minus 10 divided by 10. 12.5. I have a doubt. No. 12.5 is too high for a month. 0. Into 100. 2.5%. Correct. 2.5% is right. Those who said 12.5, you need to recheck. 9.80 minus 10 divided by 10 into 100. Minus 2%? Yes or no? Minus 2%. 9.8 minus 10 divided by 10 into 100. Number of month investment was held. Now wait. You have purchased the investment on 1/12/13 and we want to know on 31st March 14. So from 1/12/13 to 31st March 14, count how many months? Is it 4 months? Is it 4 months? 1/1/14 to 31st March 14, how many months? 3 months. 1/3/14 to 31st March 14, 1 month. If the dates are given like 1st January, 31st January, you can take months. But in some books they have done the calculation in days also. It won't make much difference. Effective yield per annum formula H into 12. What is H? This number. into 12 divided by I means divided by number of months. So one I will tell you how to do it. 9476 into 12 by 4 means multiply by 3 times. Around 2.84 or 85% you are getting? Yes or no? So then you write 2.5 into 12 by 3. Is it 10%? Is it minus 24%? Negative, minus 24%. Right. Any query on this question now? This question they have asked multiple times in the exam. Okay. And another popular scheme which they ask in the exam is dividend reinvestment scheme. Dividend reinvestment scheme, how does it operate? Whatever dividend or capital gain disbursement which they are supposed to pay you, they will reinvest it. At what rate? At X dividend NAV. At X dividend NAV. So first you have to calculate, before you apply this formula, what is the number of units you are going to get. So number of units reinvested will be equal to dividend plus capital gain disbursement, and that you divide by X dividend NAV. That means the NAV of the mutual fund after declaring the dividend. As you know, after declaring the dividend, the NAV will come down. And after calculating the number of units reinvested, the closing number of units will be equal to number of units at the beginning. Number of units at the beginning plus number of units reinvested. So first you have to prepare these two small working note. Number of units reinvested, which will be equal to whatever dividend you were supposed to receive, divide by X dividend NAV. Then calculate number of units at the end, which is the number of units at the beginning plus number of units reinvested. And then you apply the formula. And the formula is simple. It tells you what is the appreciation in the value of your investment. Number of units at the end of the period into closing NAV. This is the value of closing investment. Number of units at the beginning into initial price. This is the value of your investment at the beginning, and divide by value of the investment at the beginning. So in some books, in short, they write closing value minus opening value divided by opening value. Is it right? To get the closing value, you have to calculate the number of units at the end. Number of units at the end will be opening unit plus units reinvested. Number of units reinvested will be your whatever dividend and capital gain distribution you are entitled to, divide by X dividend NAV. Okay. Now we will solve one illustration. This illustration is also given in ICI study material of this subject, and this was asked in the exam also, CA final earlier. So they may ask in your exam also. Mr. X, an investor, purchased 200 units of ABC mutual fund at the rate of 8.50 per unit 1 year ago. Over the year, Mr. X received 0.90 as dividend and had received a capital gain distribution of 0.75 per unit. You are required to find out Mr. X holding period return, assuming that this is no load fund, has a NAV of rupees 9.10 as on today. B. Mr. X holding period return, assuming that all dividends and capital gain distribution are reinvested into additional unit as an average NAV of rupees 8.75 per unit. How many times you have to solve this problem? 2 times. Case 1, write down. Case 1. Mr. X receives dividend and capital gain distribution. Mr. X receives, case 1, Mr. X receives dividend and capital gain distribution. After that, write down holding period return. Holding period return percentage is equal to dividend plus capital gain distribution plus closing NAV minus opening NAV divided by opening NAV. So dividend is how much? 0.90. Capital gain distribution, closing NAV 9.10, opening NAV 8.5, first line divided by 8.5 into 100, 26.47%. Okay, 26.47 is enough. We are calculating return, we are not launching a rocket on the moon. Okay, you are a businessman, learn to think before decimal. Ignore your time and money after decimal points. Okay, then come to case 2. Mr. X reinvest dividend and capital gain distribution. Mr. X reinvest dividend and capital gain distribution. Okay, so now we will write down calculation of holding period return. Right hand side, write amount. Any way you present, no query on presentation. If your answer matches with my answer, go ahead, you are welcome. So first you write down opening investment value. Opening investment value. How many units Mr. X have purchased? 200 units. At what rate? 8.50. So that means he started with 1700 rupees. Do you agree? Then point number B, total dividend and capital gain distribution Mr. X is entitled to receive. So he is entitled to 200 units into 0.90 as dividend and 0.75 as capital gain. So he is entitled to how much amount in the form of dividend and capital gain? 330. Write in detail. Then write down X dividend NAV. X dividend NAV is given in the problem, which was reinvested at an average price of 8.75. Can you see the last line of the problem? Point number D, number of units reinvested. Number of units reinvested will be B upon C. 330 by 8.75. 37.71 units. Yes or no? Point number E, closing number of units. Closing number of units is 200 plus 37.71. Write in detail. Don't take chances with their institute. They will give you next chance only after 180 days. Okay. Write in detail. Written point number F. Write down. Closing NAV is 9 point how much? 10. Closing NAV. Closing investment value. Closing investment value will be closing number of unit into closing NAV. Yes or no? At the end of the year, you found that you are holding these many units. At the end of the year, NAV is 9.10. Therefore, this is how much? 2163.2 digits. Okay, 16 is enough. Now, finally, the summary of our discussion is we started with 1700. And suppose today I redeem all these units, I will get 2163.16. So, my last line of this answer is holding period return percentage. Holding period return percentage. You take 2163.16 minus 1700 divide by 1700 into 100. Hanji 27 point some percentage 0.24. Okay, write 27.24%. 27.24%. Institute answer is also 27.24. Up to 2 digits you write down. Okay. In one exam, they had asked one question, which method or which option you will go for if suppose the mutual fund gives you a choice. Which has a higher return? Right now you don't bother about that. Just depending upon you. Based on this data, just for understanding your numbers, your ability to understand the number they are asking. Of course, you have to tick mark the option at the beginning only, and all these numbers will get at the end only. So therefore, that choice is not available to you afterwards. But what institute is asking, can you understand the problem? Do you have a critical analytical skill? So that is why the question is, which option you should go for? So write down, Mr. X should choose reinvestment option because returns are higher. Because returns are higher. The question is wrong because you have to tick mark that option at the start only. When you fill that form or when you invest in that scheme. And how much will be reinvestment rate, how much will be closing NAV, that will get to know afterwards. How can you analyze closing NAV? No human effort on earth can predict future. Okay, this is my prediction. No amount of human effort can predict the future. All statistics are wrong. But we need something to take decision. That's it. So now come to entry load and exit load. Now this concept of entry load and exit load still applicable. Many people think it has gone. No. Especially the exit load is still more common, applicable in lot of schemes. If you redeem before a certain time period, they will charge you exit load. Entry load, when you enter the mutual fund scheme. Exit load, when you come out of that scheme, exit. It's like charging 2 tickets. When you enter, pay. When you exit, pay. Earlier, mutual funds used to charge you entry load and exit load both. Why do they charge you entry load, exit load, because it's an organization, it's an entity, they incur a lot of expenses to run the mutual fund. Now from where will they collect this expenses? And plus they have to give lot of commission to the agents also. More commission they will offer, more the agents or the advisor will try to promote their schemes. And competition has also increased. There are 30, 40, 42 or 43 mutual fund houses. So they started giving a lot of commission, and these advisors will do mis-selling also. They will promote the scheme which gives them more commission. Then one SEBI chairman came, Mr. C.B. Bhave, and then he made a very drastic change. No entry load now. Okay, let the investor pay the advisor according to the advice that he renders to them. If you are a good advisor, your clients will pay you. Mutual fund should not involve in paying heavy commission to the agent so that they will promote their product. They pay now, but they are very less now compared to what it was earlier, because they themselves don't get anything from the investor. And SEBI has put a cap on the expenses ratio also. That was the logic of removing entry load. So in order to incur all these expenses, they charge these loads. Funds that can be purchased without sales charge are known as no load funds. Some mutual funds do not charge any load, so they are called no load funds. Entry load is charged at the time the investor purchases the units of a scheme, and entry load percentage is added to the prevailing NAV at the time of allotment of units. Exit load is charged at the time of redeeming or transferring an investment between the schemes. Exit load percentage is deducted from NAV at the time of redemption. This amount goes to the asset management company and not to the pool of the funds of the scheme. So who enjoys this entry load and exit load? AMCs. Now understand this two simple formula. When mutual fund sell units to the investor, they charge entry load. Mutual fund to investor, so they will charge NAV, and they will also add entry load if applicable. If applicable. Okay. So investor has to pay more. Investor has to pay more. Suppose he comes with 50,000 rupees cash with him or check, and if he was suppose 10 rupees, so he was assuming I will receive 5,000 unit, very happy. But when he reaches, he finds that no, it is 10 plus 2% entry load, so 10.2. So how many units he will end up receiving? 4901 something. Up to 4 digits you can write, because units are issued in 4 digits after decimal. Okay, so now who benefited here? Mutual fund. He got less number of units, and now he goes to redeem. That day also NAV was 10. So what is the formula for repurchase price? Repurchase price means the rate at which mutual fund will repurchase, buy back from the investor. 10. That day also exit load was supposed 2%, 9.8. And when he will redeem these units, he will get only how much? 4901 into 9.80. 48030. Oh, so sad. He lost around 2000 rupees in this process. So too much of switching or redemption can cause losses to you, because they will charge you entry load and exit load. If not entry load, then they may charge you exit load. So read the scheme carefully, check the exit load, and then accordingly you take the investment decision, redemption decision, switching decision. Okay. Those who have read question number 10 below. Just for understanding, the NAV of UTI mutual fund was 23.45. The fund charged entry load and exit load. 2% entry load and 0.25% as exit load. Okay, the question is, what are the sale and repurchase price to the investor? So write sale price will be NAV plus which load? Is entry load added or deducted? I have told you the logic. They will charge you more, they will pay you less. They charge you more when they sell you. They pay you less when they buy back from you. So 23.45 and plus 2%. 23.92%. Repurchase price is NAV minus exit load. 23.45 minus 0.25%. 440. Check again. 3914. Okay. No problem. Approximately write down. So the one who wants to invest in this mutual fund, he will have to pay at the rate of 23.92, and the one who wants to redeem his unit, he will only get 23.3914. So the mutual fund earns some income which is basically used for meeting their expenses. Next paragraph is criteria for evaluating the performance. Exactly same paragraph they have copied pasted from SFM material. Is it right? Whatever income they have generated from exit load, should not exceed 2.5%. Whatever they earn from this should not exceed 2.5, otherwise SEBI will take action against them. Then in your syllabus there are 3 methods of evaluating the performance of mutual fund, which are also there in your group 1 SFM. One is called Sharpe ratio. Second one is called, remember, Tanner ratio. Third is, where did you see? In the book? Or did you remember? Okay, in the book it is printed Sharpe ratio, Tanner ratio, next page somewhere below, Jensen's alpha. Oh. Suppose you find there are 2 mutual funds in the market. Mutual fund A gives 16% return. Mutual fund B gives you 13% return. Can we conclude A is better than B? You cannot conclude. But this mutual fund advisors or companies or agents or consultants are there very smart. They will say this mutual fund has generated 16% return, this has generated 13, so invest in this. Now suppose this is an equity oriented mutual fund, and suppose this is a debt oriented mutual fund. So therefore it is not appropriate to compare the 2 schemes. Even if it is equity, but again it depends which type of equity scheme is that. This first one will be, say, small cap fund. They invest in small companies. Risk is more. This is your large cap equity fund. So again, it is not wise to compare a small cap equity fund with a large cap equity fund. If you want to compare, you have to also bring the element of risk. You have to also bring the element of risk in their calculation. After bringing the element of risk, then you compare, and therefore these three methods are there because they will also bring the risk element. After that, at least to some extent they can be compared, not again too much. In all three cases there is a warning given to you: compare apple with apple. Compare apple with apple. So even though you are comparing equity, but again the type of fund that you are comparing preferably should be of similar type, not too different from each other, because then again the comparison will not be very good. So what is Sharpe ratio? Sharpe ratio measures excess return over and above risk-free return per unit of standard deviation. Okay. So Sharpe ratio measures return earned in excess of risk-free return over and above risk return per unit of standard deviation. In Sharpe ratio, risk is measured by standard deviation of the portfolio. I am sure you remember standard deviation. It measures total risk. The symbol for standard deviation is sigma. Total risk means systematic plus unsystematic risk. Systematic risk means non-diversifiable risk, and unsystematic risk means diversifiable risk. Non-diversifiable risk is also called market risk, and diversifiable risk is also called unique risk, firm specific risk. Anyway, that was just a quick revision of your portfolio chapter. Okay. So Sharpe ratio uses standard deviation for measuring the risk, total risk. And if suppose you compare two firms now, which may have different return, but now we are dividing by standard deviation. So here we are basically calculating excess return per unit of risk. Excess return per unit of risk. So who gives me excess return per unit of risk is better? Which is better, A or B? The one which gives me higher excess return per unit of risk. So if between A and B, A has 1.5 Sharpe ratio and B has 1.8. So as per Sharpe ratio, B has performed better than A. B gives me 1.8 excess return for 1 unit of risk. A gives me 1.5 excess return for 1 unit of risk. That is Sharpe ratio. Now a lot of explanation is printed below. If you want to read, you can read. Who had given this Sharpe ratio? Nobel Prize winner, Mr. William Sharpe. Okay, he is the author of this measurement of risk. Sharpe ratio is often used to rank the risk adjusted performance of various portfolios over the same time. That means this method is useful for comparing many portfolios or many mutual funds. Okay, so do not take mutual fund, compare mutual fund only on the basis of their return. They are saying compare mutual fund, also take into account the risk involved. So therefore the one which has a higher Sharpe ratio has performed better than others. The major advantage of using the Sharpe ratio over other models is that Sharpe ratio uses the volatility of the portfolio instead of measuring the volatility against a benchmark, that is the index. So it uses the volatility of the respective portfolio or the respective mutual fund. It does not take into account the return on market index or anything. But the disadvantage of Sharpe ratio is it is just a number. It is meaningless unless you compare with other portfolio with similar objective. On its own, Sharpe ratio is useful. If I say Sharpe ratio of a mutual fund is 1.8, you don't get much meaning out of it. But if there is another mutual fund whose Sharpe ratio is 1.6, they have similar objective, then I will say A has performed better than B. Example, suppose during a period index fund earned 11%, treasury bill earned 6%. Treasury bill earned 6% means risk-free return. Standard deviation is 20%. Just calculate Sharpe ratio for this question. 11 minus 6 divided by 0.20. How much is that? 25%. The Sharpe ratio is an appropriate measure of performance for an overall portfolio, particularly when it is compared to another portfolio or another index, such as S&P 500, small cap index, etc. These are the name of index. That said, however, it is not often provided in the most rating services. Many rating agencies who rate the mutual funds or the portfolio, they do not use Sharpe ratio. They use other indicators like Trainer or Jensen's Alpha. Now, if you have to compare the two mutual funds, say A and B, A's return is 30%, B's return is 25%. Prima facie, it appears A has outperformed B. But let us also bring the risk factor and then compute the Sharpe ratio. After computing the standard deviation, we find it is 11 and 5%. Okay. So, which fund has higher or lower Sharpe ratio? Assume risk-free return is 8%. So, Sharpe ratio for A will be 30 minus 8 divided by 11. How much is that? 2. And Trainer Sharpe ratio for B is 25 minus 8 divided by 5. 3.4. So, if I strictly apply Sharpe ratio, I will say B has performed better than A. B generates 3.4% return per unit of risk, whereas A generates 2% per unit of risk. Okay. So, higher the Sharpe ratio, better is the fund on a risk adjusted return matrix. Okay. So, if I also consider the risk along with return, then the one which gives you higher Sharpe ratio is better. Comparing only on the basis of return can be erroneous. In the previous example, if you only compare return, A is better. But if you take risk adjusted return, then B is better. Then there is a general knowledge. Producing healthy return with low volatility is generally preferred by most investors to high return with high volatility. You may earn high return, but if the standard deviation is also high, it is not preferred. So automatically the formula will capture that. If you are earning high return, it means you are taking high risk also. So that will give you a lower Sharpe ratio compared to the other fund which may have a lower return but have a lower volatility also. So Sharpe ratio is a good tool to determine a fund that is suitable for such investors. Okay. Now we will continue tomorrow.